Welcome to another episode of Regtalks. In the next few minutes, we'll walk through 12 key tax and economic developments from the past week reported by RegFollower. Canada's transfer pricing changes, Belgium's Pillar 2 rules, Portugal's EU directive transposition, Estonia's tax reform proposals, Bahrain's transfer pricing guidance, Pakistan's electronic monitoring, India's path to tax certainty, Bangladesh's budget, Madagascar's mineral report, Luxembourg's fund registrations, Austria's exit tax, and the EU's low-value customs duty. Let's get into it. Canada's transfer pricing transformation. We begin in North America. Canada's rewritten transfer pricing framework is forcing multinational enterprises to navigate two competing forces: the standardized rules of the OECD's transfer pricing guidelines and the long-standing history of judicial restraint in Canadian courts. This history of judicial restraint should continue to check tax authorities' actions and potentially mitigate the impact of the changes. For groups operating in Canada, the challenge is balancing global compliance standards with local judicial precedents. Belgium issues new Pillar 2 compliance guidance. Moving to Europe, Belgium's tax authorities have issued detailed compliance guidance for the Pillar 2 global minimum tax framework, focusing on upcoming filing deadlines and local notification requirements. As European jurisdictions transition from legislative design to practical enforcement, the compliance burden on corporate tax teams is growing. Multinational groups with Belgian operations must act quickly to gather the necessary data, allocate tax liabilities, and align local filings with their global Globe Information Return strategy. Portugal transposes EU directives and refines IIR. In southern Europe, Portugal's parliament has enacted a new law transposing EU administrative cooperation directives and refining its domestic Pillar 2 income inclusion rule framework. The legislation aims to streamline administrative exchange and ensure the IIR operates smoothly alongside broader EU rules. For businesses, compliance in Portugal is becoming more integrated with EU-wide reporting standards. Multinational groups must review their structures to ensure their Portuguese entities meet these refined obligations and align with updated cooperation requirements. Estonia Economic Survey recommends tax base expansion. Next, the OECD has released its latest economic survey of Estonia. While the country's economic conditions are improving, the OECD emphasizes the need to mobilize additional revenues in a growth-friendly and fair way. The report recommends broadening the tax base and shifting part of the tax burden away from labor towards corporate and property taxation. For businesses in Estonia, this indicates a shifting policy landscape where corporate tax structures and property holdings may face increased scrutiny. Bahrain publishes transfer pricing guidance for MNEs. In the Middle East, Bahrain's National Bureau for Revenue has issued new transfer pricing guidance. The guidance outlines arm's-length pricing principles, approved methodologies, and documentation requirements, which are integrated with Bahrain's global minimum tax regime. For multinational groups in Bahrain, this means transfer pricing is no longer just a compliance exercise, but a critical element of global tax planning. Businesses must ensure that local transactions are fully documented and aligned with OECD standards. Pakistan updates guidance and electronic monitoring. Over to South Asia. Pakistan has introduced updated guidance on draft tax returns, registration requirements, and electronic monitoring for key manufacturing sectors. These measures represent a push by the Pakistani tax authorities to improve transparency and compliance in domestic production. For corporations, the introduction of electronic monitoring means that operations and inventory tracking will face real-time oversight. Affected businesses must ensure their systems are aligned with these registration and electronic tracking mandates. India transfer pricing rules call for documentation. Also in South Asia, recent updates to India's transfer pricing rules highlight the steps multinationals must take to achieve tax certainty. Tax authorities are placing greater emphasis on robust documentation and proactive dispute resolution, such as advanced pricing agreements. To navigate audits successfully, businesses must preserve detailed evidence of their pricing decisions along the way. In India, tax certainty is built on documentation. Maintaining clear, contemporary records is the best defense. Bangladesh announces growth-focused 2026-27 budget. Rounding out South Asia, Bangladesh has announced its 2026-27 budget. The budget introduces bold policy measures including sweeping deregulation, a massive SME stimulus package, and significant foreign investment incentives. These policies aim to transition Bangladesh from a low-cost manufacturing hub into a more competitive, open economy. For multinational investors and local businesses, the budget offers new avenues to scale, though success will depend on how effectively the tax authorities roll out these incentives. Madagascar Critical Minerals Report emphasizes diversification, moving to Africa. A new report by UN Trade and Development highlights opportunities for Madagascar to add value to its critical energy transition minerals, including nickel, cobalt, and graphite. The report advises Madagascar to diversify its economy beyond raw mineral extraction by developing domestic processing capabilities. This would allow the country to capture more value and create local jobs, provided projects align with national economic goals and local community development. Luxembourg updates FAQs on Pillar 2 registration. Back to Europe, the Luxembourg administration of direct tax has updated its FAQs regarding Pillar 2 global minimum tax rules. The guidance clarifies that registration is an autonomous obligation, meaning every constituent entity, joint venture, and JV affiliate must register, regardless of whether they have a filing requirement or qualify for safe harbors. Crucially, the rule applies separately to individual compartments of umbrella funds, which must obtain dedicated tax identification numbers before the upcoming deadlines. Austria approves exit tax reporting under Budget Measures Act. In Austria, the National Rat has approved the Budget Measures Act 2026, introducing a new annual reporting obligation for taxpayers subject to exit taxation. Individuals who have relocated their tax residency must now provide annual proof to the tax office that no taxable exit event has occurred, provided their relevant income exceeds 100,000 euros. Taxpayers can submit this proof either in writing or electronically via the Finance online portal, aiming to reduce tax avoidance. European Union to end low-value customs duty exemption. Finally, the European Union is set to eliminate the customs duty exemption for low-value shipments valued up to 150 euros starting July 1st, 2026. Under the new interim rules, a flat rate customs duty of €3 per item category will apply to small parcels imported from outside the EU. This temporary measure, designed to protect EU-based sellers from unfair competition, will remain in place until a permanent customs framework is introduced in 2028. That wraps up our roundup. This week's themes show a clear trajectory. Pillar 2 is shifting from policy to mandatory local registrations. National tax administrations from Canada to India are demanding rigorous transfer pricing documentation, and the European Union is tightening customs controls on global e-commerce. Staying compliant means keeping up with these operational realities. Thanks for watching Regtalks.